my nervousness is that the sudden lack of liquidity might have to do something with the fact that bankers might be beginning to doubt each other's solvency, which is a different issue.
Welcome back to Finance and Liberty and Reluctant Preppers. We have a returning guest. Rick Rule is the CEO of Sprott Asset Management. He's joining us from his office in Carlsbad, California on this Tuesday, November 19th, 2019. Rick, thanks for joining us.
Dunnigan, it's always a pleasure. Thank you for having me back.
We're glad that we were able to make this connection happen, and we're working with some technical difficulties, but I think our audience will bear with us, and we'll get through this just fine. So we wanted to circle back with you for a couple reasons. One is we have some viewers' questions we'd like to put before you, but also we've had some rather extraordinary things happening in the financial world that we'd like to get you to weigh in on. First of mind is this mysterious and sustained bond repo action by the Federal Reserve, which originally was told, well, the cover story was, it's just to help some banks get through some third quarter tax payment, a little cash pinch that was happening. Then, oh, by the way, we're going to keep this going on into October. Actually, we're going to keep it going on into November. Forget it. At least January. And oh, by the way, we're going to be increasing. And it's not QE, and the president is saying nothing about it. So what's your personal opinion on what's actually going on and what this seems to indicate about the health of our financial system?
Well, with the caveat at the beginning that there's a lot of things that are happening in the financial system that I don't think that anyone with a grasp of basic arithmetic can understand. I will try, that notwithstanding, to explain what I know. One of the official explanations has to do with the fact that the U.S. dollar is so strong that there is demand for it from outside the U.S. banking system, and therefore there is a shortage of dollars. I'll leave that as an explanation. Normally, when a repo action is required, it's a consequence of a lack of liquidity in the financial system. And that is often a circumstance where banks don't have the courage to make short-term funds available to other banks because they are afraid in the event of greater illiquidity that they would become unsecured lenders in the overnight market. In other words, the Fed steps in to act as lender of last resort in the absence of more conventional liquidity in the money market fund. Repos, after all, are agreements to borrow and then pay back federal securities. The collateral is, in every case, at least in the near term, money good, because the Fed retains the power to print. What it means in normal circumstances is that the lending counterparty doesn't feel that the borrowing counterparty is necessarily in a condition to repay them, meaning that banks don't trust each other. From what I understand, the big thinkers are saying nothing could be further from the truth. It's just that I don't understand any other explanation. There may well be another explanation, but normally in circumstances like this, the easiest explanation is the best.
Okay, so following that chain of logic that perhaps we're seeing evidence on the surface, this sort of ugly, dirty laundry that the banks aren't trusting each other, but if all they would really need to be trusting is that the other bank actually has the collateral, has the federal notes so that they could get the cash back if they needed to, is that actually like a second level of the onion to peel back and say, wait a minute, it's not that they're asking if the other bank has cash to pay them back, it's that they actually have the collateral that's good for the loan?
Well, or will there be a time lag in their ability to deliver? Overnight funds are supposed to be just that. Overnight, they're a way to park liquidity for fractional returns because the duration is so short. But certainly any delay in repayment would perhaps impair the liquidity of the lending party too. With the caveat again that I'm a reasonably experienced conventional lender, the circumstances surrounding the Fed and the member banks have always been a bit of a mystery to anybody who studied money and banking.
Are you able to put to rest the confusion that's been flying around about whether, in fact, this nightly amount, whether it's 45 billion or 75 billion or 105 billion, depending on who you ask, is just a slush fund that just keeps getting reused night after night after night, or is it actually accumulating and accumulating and accumulating to add additional liquidity into the system?
No, my belief is that this resets. My belief is that the overnight funds are just exactly what they're suggested to be. They're banks lending to and borrowing from each other to adjust their overnight liquidity needs and abilities. If you think about the Fed, the fact that the Fed suggests that a bank that has equity backing at 7% of total assets by way of equity is well capitalized, there are times in a bank's year where it would be perfectly understandable that they would have liquidity shortfalls, even though their balance sheet was in relatively good condition. You'll recall earlier in other interviews on your show, I talked about the current situation as liquid as opposed to solvent. There are circumstances where people have assets that are ultimately money good, meaning that they're solvent, but they aren't in the near term liquid. Yep. And the overnight money markets are meant to address changes in liquidity through an otherwise solvent system. The nervousness, let me rephrase that, not the nervousness, my nervousness is that the sudden lack of liquidity might have to do something with the fact that bankers might be beginning to doubt each other's solvency, which is a different issue. And I freely admit that I could be way, way, way wrong. My expertise really is balance sheets and income statements among natural resource companies and banks that are much smaller than the type of banks that you and I are currently describing.
Sure enough. Okay, well, that at least gives us some insight into what your thinking is at and gives us a little more clarity about. But, it's interesting because we've had multiple people weigh in on that, talking about the banks evidently not trusting each other. And there has been some talk about the potential for rehypothecation of the Treasury bonds, which would mean that their surety, their collateral isn't even considered rock solid either. But that it continues to unfold. It's curious to many that we don't hear any comment, because with Trump calling for a weaker dollar and calling for lowering of interest rates and that sort of thing, you'd think that if the first scenario that you described of a strong dollar kind of sopping up, being in short supply because it's so sought after internationally, would be just fire in his cannon, just saying, see, this is what's going on. So any concept of why we're hearing silence from the president on this action?
Again, my personal supposition is that economics and, in fact, commerce isn't necessarily this president's long suit. And my fear is that he is roughly as knowledgeable on the topic as myself, which is to say, not very. A terrifying response indeed. Perhaps his normal method of communication, which is 120 characters or less, is insufficient to describe the problem. I honestly don't know, and I'm sure that the Trump fans among your viewers will hate that response, but I don't have a better one.
Well, I'm thinking about the reputation of our channel as not being just a fear and gloom and doom, but now that you've said that what you just said, I'm afraid I'll be accused of that. Okay, if we can turn our attention to some of our viewers' questions with your permission. Demented Uncle asks, describe the current environment for junior miners, and where do you see the industry moving in the next 6 months?
I think the current environment for junior miners, from a speculator's point of view, is pretty good. I think the junior miners themselves, the issuers, wish that capital markets conditions were easier, meaning I think they wish it was easier for them to raise money. From a check writer's point of view, I think they've had it too good for many, many years. And the fact that they have to be fairly judicious with the capital that they raise, and that they have to be horrors, competent human beings with high quality projects to raise money, I happen to believe is a good thing. We at Sprott are able to sell out virtually every private placement that we touch, with lots of demand left over. That being said, we probably agree to participate in one private placement transaction for every 30 that come across our desk. Either the quality of the placement is too low, or the proposed terms from the issuer to us feel unfair from our point of view to our subscribers.
Let me interrupt just for a clarification question, because this is somewhat new to me, what you're describing, and it may be for some of our viewers as well. So what you're saying is that junior miners seeking funding, rather than always reaching out to banks for funding, can also reach out for private sources of funding, individual investors or investment groups or whatever, and you serve as an intermediary in some of those, so they approach you, but you think that only about 1 out of 30 of those junior miners that are coming at you for that kind of private funding attract your attention as something that's high quality enough that you want to represent it to your investors and say, guys, I think this would be maybe a good one for you to consider. But when you do, there's plenty of people lining up with money to step up for those. But you're just saying that there's a lot more askers than for that kind of funding than you think are prudent for you to represent to your potential investors.
That is correct. Okay. Almost all junior resource issuers require equity rather than debt. So they would, of course, come to us rather than banks. And as you suggest, those of us who come to equity, we are finding about 1 in 30 are companies that we are able to agree to prices and terms on. In those circumstances, there's lots and lots and lots of money available at Sprott, and probably elsewhere too. There is still a dearth of quality relative to the sort of breadth of the market. We see a situation now in the high net worth retail sector, that is private placements available from non-institutional sources, but rather from accredited investors. Between now and sort of the end of January, wealthy people begin to worry about what they should be worrying about, which is their family and the holiday season. And they seem less interested in the filthy lucre. And so at this period of time, the availability of capital slows down simply because the providers of capital are more interested in their family than they are analyzing private placements. That, of course, will turn around come February, I'm certain.
We've got some questions related to this, I believe. This is a particular miner, and I know that you have offered in the past to evaluate lists of resource companies that people send you, and we'll ask you about that near the end, but this is a particular one. And Gabe T. says, Mr. Rule, what do you think of EnviroLeach Technologies, EVLLF? Do you see them as a game changer?
With the caveat that I don't know the questioner well enough to give him anything that would resemble individual investment advice.
Right. He's asking about the company itself, right?
That's correct. I don't own EnviroLeach, and I don't own it in any accounts that I manage, which is a long way of saying, while it might be attractive to others, while the technology might be attractive to others, the very, very best I can say is that I don't understand it well enough to own it myself or own it on behalf of managed accounts.
There's you were talking about banks a few moments ago. One of the biggest, JP Morgan, it gets a lot of attention from precious metals investors because of the various roles that JP Morgan either is undeniably or purported to play in the precious metal space. Dr. Collapse asks, if convictions are brought against JP Morgan under the RICO Act, what will this lead to?
Well, that's an open question. If convictions are obtained against J.P. Morgan itself under the Racketeering and Corrupt Organizations Act, I don't believe that they will be. I'm not trying to say that they aren't necessarily guilty of racketeering, or that employees of J.P. Morgan aren't guilty of racketeering. If the bank itself, or if an important subsidiary was found guilty of racketeering, that would be the end of the bank. Racketeering allows the prosecutor to total real damages and exemplary and punitive damages, and then arbitrarily triple the sum. And it allows, in the event of a criminal conviction, very wide latitude to the prosecutor to do whatever is required to secure the public trust in the markets. If, by contrast, the courts found no civil or criminal wrongdoing on the part of the institution, but rather came to the conclusion that the alleged misdeeds were the private work of employees of J.P. Morgan, or if J.P. Morgan were able to plead their way out of any circumstance, then I think the situation from the institution's point of view would be, what's that phrase? Severe but survivable. These are serious charges, and they go to the fact that not just precious metals, but really many markets have been manipulated, at least in the short term, for a very long time. I'm not one of those who is convinced about decades-long manipulation by the financial services industry or government. But I've been in the financial services industry now for almost 45 years. And I know that near-term, short-term manipulation, spoofing, lying, jitneying, all those things, however illegal, take place every single day. And a market that is as dislocated between physical and future or paper as the gold market and the silver market is particularly prone to manipulation. A party, not necessarily J.P. Morgan Chase, but a well-capitalized party that was active in many markets could, as an example, establish a short position in the futures market, which trades 100 to 150 times the volume that the physical market trades, and then sell either from inventory or short aggressively in the physical market, manipulating, therefore, the thinner market, the physical market, to spoof or alter the price of quotes in the futures market. And by doing that, reap potentially very large returns relative to the capital at risk. This is a very illegal activity. And my suspicion, I don't know this to be the case. This is a league I don't operate on. But I suspect it's fairly common.
We have a related question from Tora Johansson, who asks, as all derivatives with gold as underlying asset are multiple times the available amount of gold, you just made a comment about the volume of trading there, does that mean that the demand for gold is multiple the available amount of gold as well?
Not necessarily. When you look at all derivatives markets, what you see is that the nominal amount of derivative exposure relative to the net amount of derivative exposure is very high, meaning that derivatives in the equities markets may total, pick a number, $100 trillion. Well, that's the notional value. Well, the real value between the long and the short positions may be $1 trillion or $1.5 trillion. The problem, therefore, isn't necessarily the solvency of the market as a whole, but rather the liquidity of individual counterparties. It doesn't take an awful big misallocation among a leveraged participant to trip a lot of daisy chains. It may be ultimately that the market can come back into balance in 6 months or 7 months or 12 months, but that doesn't mean that there couldn't be a multi-billion or even $1 trillion imbalance in the shorter term, which would obviously be extremely uncomfortable for all concerned.
Speaking of a time that would be extremely uncomfortable for all concerned, there are several questions in this following about kind of like early warning signs of a breakdown of the system itself. John Caleb Warren asks, if the dollar begins to collapse, what will be the first signs to watch out for before the bottom drops out?
I don't know. In most cases, the trigger of major financial collapses has to do with some specific, not widely foreseen event, a so-called black swan. And by their nature, black swans are often fairly obscure. I think back to the 2008 financial panic, which was, I think it's widely held, triggered by a collapse in real estate securities, collateralized mortgage obligations and such. I remember myself driving north on the 405 freeway, not being a real estate lender necessarily, and seeing a billboard on the right side of the freeway. This is in 2006 probably. And it said, borrow 125% of the value of your house. Bad credit, okay. And I remember thinking, I wonder how that's going to work out. I suspect not very well. Despite that, it was a black swan, even to me. I'm trying to figure out how you could loan somebody who had lousy credit 125% of the value of the collateral and get paid back. It didn't occur to me that that circumstance was as broadly based as it was. And in response to your viewer's question, normally, if the signs of collapse were visible, a slow motion rather than a rapid collapse would occur. When you and I discuss circumstances around the American economy, as we have done in the past, $22 trillion in on-balance sheet liabilities, $100 trillion in off-balance sheet liabilities, the nation's proposal to service those liabilities with the national income, which is tax and fees less expenditures. In other words, servicing a positive sum with a negative sum. That's very difficult. So when we look at the purported strength of the United States dollar against, as an example, a trade deficit, a financial deficit, and a budget deficit, we get nervous. It feels like the U.S. dollar should be weak, but the U.S. dollar is strong because, as untenable or unpleasant as our situation might be, ironically, on a global basis, it's pretty good. So that simply points out the fact that your viewer is asking a question that, while valid, I don't think very many people, certainly not me, are capable of answering. Surprises are, of course, by definition, surprises. When I look into my crystal ball with regards to that outcome, it is sadly cracked and cloudy.
There's other questions about a potential crash. Hardy Potter asks, I hold physical gold and silver and also some mining stocks. If general stocks, the general stock market, may go down in the near future, as some predict, when there is some sort of crash going on, how will gold and silver mining stocks behave? Will there be an inevitable drawback on them also? Should I hold on to them?
Dunnigan, your viewers absolutely need to understand that gold stocks are stocks. When stocks decline precipitously, particularly in response to liquidity constraints, everything sells off, but particularly peripheral assets. And there is no asset in the world probably as peripheral as a junior mining stock with no visible means of sustenance other than future equity raises. The difference is, of course, that well-capitalized gold mining companies tend to do very well in the aftermath of collapses, because the policy response to a collapse is almost always debasement of the currency, which is almost always good for gold and almost always ultimately good for mining stocks. But I'll take you back to the collapse in 1987. Gold stocks held up for one day. The collapse of 2000, gold stocks held up for 1 day or 2 days. The truth is that gold stocks are stocks, and junior gold stocks are peripheral assets. And peripheral assets don't get hurt, they get hammered in a liquidity squeeze. Gold itself would sell off in the near term in a liquidity squeeze, because the sale decision isn't made by the investor or the speculator. It's made by the margin clerk. And he or she sells any asset that has a bid to protect the value of the collateral held by the brokerage firm or lending institution. So anything that has a bid, including treasuries and gold, gets hammered in a liquidity crisis.
There's a question from Mary Jane who asks, with gold now being declared a Tier 1 asset, I think she's referring to the Basel III regulations that went into effect, what would a confiscation look like if it comes? Ban selling bullion, forced liquidation, windfall tax?
I should begin by saying that I don't believe that the government will confiscate gold again. I believe that there are easier, more politically palatable ways to steal your savings. The debasement of the currency is one that's supported by the president and most of the president's constituency.
Well, it's also got over a century of precedent of it's been demonstrated right before our eyes.
Correct. The increase in tax, particularly against the wealthy, a different form of theft. That is theft that's concentrated on a group that is target rich but vote poor. Is something that would be, in many circumstances, politically palatable. The increase in the debt and deficit, that is, transferring the obligation from you and I to our children, is something that's probably much more popular among us than it is for them. But the truth is that all of those incremental forms of theft are politically easier than overt theft, like confiscating gold or confiscating IRAs. So my suspicion is that among the worries that your listeners have, that should rank fairly low.
Let me modify the question, if I may, because this is not fair, but I'll do it anyway. Instead of talking about outright confiscation, because as you've mentioned, things have been so done right in front of in plain view for so long that we've gotten used to things that people no longer even see them as theft anymore and don't connect the dots. If there were going to be a confiscation of IRAs, for example, I'm sure, like they were talking about the My IRA concept, where for your own stability, for your own security, for your own safety, and for your own good, a certain portion of your IRA would need to be invested in treasury bonds, for example, or something like that. Or in the case of gold, it wouldn't be outright confiscation. It would be a certain amount needs to be exchanged for currency to the government to help with a currency crisis. So don't be a hoarder, be a patriot, or something like that. Wouldn't it all be wrapped in the flag and wrapped in sugar to make it seem like it's a good idea?
Should it occur, I think the answer is yes. But I think it is much more likely that the government would impose, say, a wealth tax of 2.5% annum on people with estates above $5 million. Stealing from the rich is an extremely popular concept.
Politically, yeah, okay.
Yeah, so my suspicion is that the theft will concentrate on a target-rich, productive part of society rather than on a broader part of society. And my other suspicion is that the amount of money that they could steal in the gold sector is fairly small. The value of precious metals and precious metals-related securities in the U.S. savings and investment matrix is between 1/3 and 1/2 of 1%. Were you going to steal an asset class, why wouldn't you lower the interest that you paid on the U.S. 10-year Treasury again? In other words, why wouldn't you steal from savers on the installment plan from a big asset class rather than from a small asset class. I note with some humor, and I don't want this to go too far on your show, but I suspect that the overlap of gun owners and gold owners is very high. And were I going to steal from a class of citizenry in the United States, my suspicion is that I would steal from little old ladies and pensioners rather than well-armed, grumpy old gold hoarders. It just seems safer to me.
Safer for some.
Yeah. I'm putting myself in their shoes. You know?
Yeah, here's a tough one, but I think we can work our way around it. The Prepared Mind asks, Rick doesn't give advice, but if Rick were Rick with his knowledge, but only age 30 and had 50K, how would Rick invest it in precious metals foreseeing the current economic situation unfolding?
Assuming that I had no other precious metals holding in my portfolio, I mean, there's a whole bunch of assumptions there. I would have at least half of the money in either physical precious metals or surrogates, preferably, of course, the Sprott exchange-traded physical products, which I believe to be superior for a U.S. taxpayer. And I thank your viewer for that opportunity for an advertisement. Of the balance, I would have probably at least 2/3 of the balance of the money, of the other half, in other words, in very high-quality gold stocks. Things like Franco-Nevada, Wheaton Precious, Agnico Eagle, Barrick. Because the truth is, when you get a recovery in the gold market, the market itself gives you so much performance that you don't have to take too much risk to outperform it. We've talked about that 40-year gold chart on your program before. That chart teaches us that we are about at or just off the bottom of gold stock valuations over a 40-year time frame. The chart also teaches us that the nine prior recoveries from oversold bottoms varies between 200% and 1,200%. So you don't need to take inordinate risk to outperform the market when the market gives you that extraordinary return. And then perhaps if your listener was willing to educate himself or herself on the junior sector, participating with maybe 10 or 15% of that $50,000 in the smaller producers or a carefully chosen package of juniors in order to amuse oneself and give somebody the possibility of a 10-to-1 return. That's the sort of risk that 30-year-olds that can deliver value to society, where the value is represented by, a reasonable paycheck, are able to afford. At 30, you can afford to take some risks,
right?
Provided that you can provide for your family in other ways.
If that's not your main source of income, your bread and butter.
Right.
Got it. Okay.
Right.
A little shift of gears here. Dinoplasm 2 asks, where does Rick see the price of rhodium and platinum headed?
I have no opinion on rhodium because the market for rhodium is so small. And rhodium is produced almost exclusively as a byproduct of other materials. And unless you have an outlook on the market for those materials, you don't know what the supply of rhodium is going to be like. My rhodium price forecasting track record is unblemished by success, and I wouldn't burden your caller with my response. I believe in the near term, the platinum price probably declines because I'm nervous about the industrial application for platinum, particularly in diesel vehicles. Longer term, the price of platinum almost has to go higher because 60% of platinum that's produced in the world is produced at a loss. And it's also produced in 3 countries. It's produced in South Africa, a basket case, Zimbabwe, a worse basket case, and Russia, which is actually a fairly good country. But the degree of political stability around the supply of platinum is horrific. If there was any dislocation, particularly in South Africa or Russia, you would see supplies of platinum falter very, very, very quickly. And what's important to know about platinum is that its utility in fabrication is extraordinarily high, its economic utility. At current prices, it takes about $120 worth of platinum in a catalytic convertible to sell a $40,000 or $50,000 diesel vehicle. If the price of platinum doubled, it wouldn't impact the finished price of the car at all. So the price of something that can go up because of its utility and ultimately must go up because of the cost of production probably will go up. But it doesn't need to happen in the near term, particularly if we enter a global or an American economic slowdown.
Well, Rick, before we go, I promised in the beginning we'd circle back and ask you about just reminding you that in the past you've offered to rank the portfolios on natural resource stocks and companies that our viewers are interested in. Is there an opportunity to renew that offer at this point?
I'm delighted to do it. I have enjoyed many conversations with your viewers. I've answered a lot of questions, separate and apart from those related to specific companies. So I will renew the offer with a caveat. We're still working off a backlog of earlier requests. So for patient viewers, if they will email me their portfolios and email it in the text, not as an attachment that a 66-year-old can't open, with the names and the symbols in the text, I will send back the Barron's Gold Mining Index chart, which is really, really, really instructive, as a special bonus for your subscribers only. A 100-year commodity chart, which is also really interesting reading. And in addition, personalized rankings and, where appropriate, comments on the companies in those listeners' portfolios.
And just to clarify, they should be emailing this to rankings@sprottglobal.com?
That's correct. rankings@sprottglobal.com.
And I think you stated last time, to clarify, you're not ranking these as stocks for immediate investing. You're ranking them as companies based on your view of their business.
Correct. I am ranking them almost irrespective of risk. Risk-adjusted internal rate of return relative to enterprise value. And my own rankings are personalized.
Very good. We've been speaking with Rick Rule, the CEO of Sprott Asset Management. Rick, as always, on behalf of our viewers, thanks for joining us here on Finance and Liberty and Reluctant Preppers.
Always a pleasure. I always enjoy the process, and I always enjoy visiting with your viewers.
And now I'll see if I can pounce on you for one last bonus question for our Patreon subscribers.
Sure, absolutely.
Great. So if you're not already a supporter of Finance and Liberty and Reluctant Preppers, please ask yourself how much value this is adding to your life, and if it's bringing value to you and you want to help make it possible for us to continue this, please go to patreon.com/reluctantpreppers, and for an amount of any monthly pledge, you can access this and other bonus content. A $10 per month membership will really make a extremely helpful at being able to keep us on the air and producing this content for you. Hey, Reluctant Preppers, if you want to hear more bonus footage from other guests we've had on, come on over right now to patreon.com/reluctantpreppers and access that bonus footage there. Take care.
It seems so hard to order. Who can I trust, and how do I even start?
Oh, you just go to sdbullion.com/RP, pick out whatever gold or silver you want, add it to your cart, you can check out, and it's on its way. And they're A+ rated by the Better Business Bureau.
Wow, it's that easy?
Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/RP.
After I order gold or silver, how can I trust I'm going to get it? And I don't want everybody to know that I'm ordering gold and silver.
Oh, it's okay. It's fully insured, it's trackable, and you have to sign for it, so nobody else is going to get it but you, and it comes discreetly packaged. If you order a small amount, like maybe gold, it'll probably come in a box that looks something like this.
Okay.
And if you order a large amount, maybe like silver, it'll come in a box that looks something like this.
Wow.
But it doesn't say gold or silver on there. It might say something industrial or something else like that, but nobody's going to know what you ordered.
Oh, that's great to know.
Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/RP.
If I own gold or silver, how will I ever be able to spend it?
Oh, sure. Well, consider good times or bad times. Like in good times, you can sell it back to the same place you bought it from. sdbullion.com/RP will buy it back at the best price guaranteed on the internet. You can take it to a local coin shop and get cash in your hand, completely anonymous. Some people you know may be willing to take gold or silver coins in exchange for goods or services. Now, in bad times, when things have really fallen apart, time after time in history, people have found that in hard times, gold and silver really does come through as something that people recognize as value even after everything else has failed. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/RP.
What if gold or silver drop in price after I order it?
Well, everything fluctuates with time, but nothing has held up longer and better than gold and silver throughout all the changes that have happened in history. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/RP.
What good does gold do me anyway? I can't use it for anything.
Well, I think I found a form you might appreciate.
Wow. That's beautiful. Wow, I can wear that just about anywhere.
And you can take it with you through airport security and across borders. It's small and compact and lightweight, and you can even hand it down through generations. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/RP. Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.